With election day upon us, let's take a look at how politics and investments can work out for the markets. As we go into election day, it's more or less evenly split, with looking like Republicans take back control of the House. The Senate is split right down the middle, more or less toss up. What's interesting about midterm elections is the sitting party's president usually loses seats in Congress, and this has been the same going back 100 years. You've only had three races where the actual sitting president's party gained seats during a midterm election. So you'd expect the pre-election data to hold true so far. Midterm election years are interesting. They actually show a little bit more increase in volatility relative to all other years. And that volatility tends to pick up right around the time of the election, as you see here, August, September, and then into October, and then starts to fall off as the year ends. The average midterm election year, performance-wise, has been more or less muted the entire year, as you see here in the dark blue line, with markets going sideways and in fact negative territory, and then picking up steam as you get into that election cycle, whereas all other years the market is biased towards the upside without question. We're coming into the best 6 months of a four-year presidential cycle, actually. 18 out of 18 midterm election cycles have produced a positive return for the stock market going back to the 1950s. You don't want this 6-month window to be an asterisk, given everything that's going on with the unfortunate war in Ukraine, inflation doing what it's doing, and rising interest rate policy at stake. But we also saw this next 6 months, even in the 70s and early 80s, produce a pretty substantial high return. The midterm election cycle shows a seasonal pattern, and when you take a look at the second year new Democratic president, which is what we have now, as the red line is your worst performer going into November. After that election takes off, though, the market picks up going into year end. Fascinating thing, long-term data, going back to post-World War II, the third year of every president's term has been the best year without question. And you've only had one negative year, that was during the Carter administration, third year, 1979, where that third year produced a negative return in the markets. And in fact, Republican, Democrat, didn't matter, overall a return of 18%. And that third year of a sitting president's term was the highest return by far versus long-term history. And visually taking a look at this, the low point during the presidential cycle happens around that midterm election. You get the pickup into the fourth quarter, and that third year tends to produce a pretty substantial positive return. 1 year out from midterms. So if we're taking a look at November 2023, what's likely to occur? Well, yet again, we have 100% probability that the market is up over the following year. In fact, your average after midterm election cycle is 15.1% return, whereas all other years are looking at about a 7% return in the equity markets. What happens if you have unified Congress, unified government, or split Congress? Statistically, your best outcome is having a split Congress, but it's only marginally better than a unified government. Once we take a look at all of this data, you really arrive at a place where you realize, I don't think it's the outcome of who takes control of what that matters. It's the investor uncertainty principle. People want to know more or less who's going to be in charge and what the rules are likely to be. The markets tend to like that, and capital is allocated accordingly moving forward. We have one other wind at our backs, and that's going into the fourth quarter when the market is down as much as it was. It was down right at 25% when September ended. The fourth quarter return tends to be pretty nice, regardless of a midterm election year or not. The only exception to that was 2008. That's when the financial crisis was unfolding, and the market continued to go down with the collapse of Lehman Brothers in October that year. This is not the financial crisis by far. So we could likely see a very nice fourth quarter bounce as we get the midterm behind us, and we move on to what regulation should look like for the next couple of years to come. I'm Chad Seegers. Thank you for tuning in. Give us a call if you have any questions about what's going on in your portfolio.